Hi there. In our previous episode, I made a start about how to calculate the cost of capital. I discussed the time value of money concept and then talked about the riskless security, which forms the usual starting point in discussing risk and return models in finance. Today, therefore, is part 2, where I want to discuss the cost of equity. Remember, equity is one of the sources of funding for the firm and therefore forms part of its capital structure and is a component of the cost of capital. But before I continue, do visit our website where I curate news and publications from international financial organizations and central banks. Topics cover a wide range of financial and economic issues that affect individual countries or the world economy. For instance, COVID-19, inflation, or the war in Ukraine. Please also subscribe to this channel and be informed whenever we publish a new video. The expected return for equity investors would include a premium for the equity risk in the investment. We label this expected return the cost of equity. In other words, the cost of equity is the rate of return investors require on an equity investment in a firm. The risk and return models need a riskless rate and a risk premium. They also need measures of a firm's exposure to market risk in the form of betas. These inputs are used to arrive at an expected return on an equity investment. The expected return is equal to the riskless rate plus beta multiplied by the risk premium. This expected return to equity investors includes compensation for the market risk in the investment and is the cost of equity. In the capital asset pricing model, the beta of an investment is the risk that the investment adds to a market portfolio. There are 3 approaches available for estimating these parameters. One is to use historical data on market prices for individual investments. The second is to estimate the betas from the fundamental characteristics of the investment. And the third is to use accounting data. We will look at all 3 approaches next. The conventional approach for estimating the beta of an investment is a regression of returns on the investment against returns on a market index. For firms that have been publicly traded for a length of time, it is relatively straightforward to estimate returns that an investor would have made on investing in the firm's equity in intervals, such as a week or a month, over that period. In theory, these stock returns on the assets should be related to returns on a market portfolio. That is, a portfolio that includes all traded assets, to estimate the betas of the assets. In practice, we tend to use a stock index, such as the S&P 500, as a proxy for the market portfolio, and we estimate betas for stocks against the index. Many users of betas obtain them from an estimation service. Merrill Lynch, Barra, Value Line, Standard & Poor's, Morningstar, and Bloomberg are some of the well-known services. All these services begin with the regression beta just described and adjust them to reflect what they feel are better estimates of future risk. The process for estimating betas in markets with fewer stocks listed on them is no different from developed markets, but the estimation choices on return intervals, the market index, and the return period can make a much bigger difference in the estimate. When liquidity is limited, as it often is in many stocks in emerging markets, the betas estimated using short return intervals tend to be much more biased. In fact, using daily or even weekly returns in these markets will tend to yield betas that are not good measures of the true market risk of the company. In many emerging markets, both the companies being analyzed and the market itself change significantly over short periods of time. Using 5 years of returns for a regression may yield a beta for a company and market that bears little resemblance to the company and market as it exists today. Finally, the indexes that measure market returns in many smaller markets tend to be dominated by a few large companies. For instance, the Bovespa, the Brazilian index, was dominated for several years by Telebra, which represented almost half the index. Nor is this just a problem with emerging markets. The DAX is dominated by Allianz, Deutsche Bank, Siemens, and Daimler. When an index is dominated by one or a few companies, the betas estimated against that index are unlikely to be true measures of market risk. In fact, the betas are likely to be close to 1 for the large companies that dominate the index, and wildly variable for all other companies. The historical approach to estimating betas works only for assets that have been traded and have market prices. Private companies do not have a market price history. Consequently, we cannot estimate a regression beta for these companies. Nevertheless, we still need estimates of cost of equity and capital for these companies. A second way to estimate betas is to look at the fundamentals of the business. The beta for a firm may be estimated from a regression, but it is determined by decisions the firm has made on what business to be in and how much operating leverage to use in the business, and by the degree to which the firm uses financial leverage. A third approach is to estimate the market risk parameters from accounting earnings rather than from traded prices. Thus, changes in quarterly or annual earnings at a division or firm can be related to changes in earnings for the market in the same period to arrive at an estimate of an accounting beta to use in the capital asset pricing model. While the approach has some intuitive appeal, it suffers from 3 potential pitfalls. First, accounting earnings tend to be smoothed out relative to the underlying value of the company, as accountants spread expenses and income over multiple periods. This results in betas that are biased down, especially for risky firms, or biased up for safer firms. In other words, betas are likely to be closer to 1 for all firms using accounting data. Second, accounting earnings can be influenced by non-operating factors, such as changes in depreciation or inventory methods, and by allocations of corporate expenses at the divisional level. Finally, accounting earnings are measured at most once every quarter and often only once every year, resulting in regressions with few observations and not much explanatory power. In other words, low R-squared, high standard errors. For most publicly traded firms, betas can be estimated using accounting data of market data or from the bottom-up approach. Since the betas will almost never be the same, using these different approaches, the question is, which one do we use? We would almost never use accounting betas for all the reasons specified earlier. We are almost as reluctant to use historical market betas for individual firms because of the standard errors in beta estimates, the failures of the local indexes, as is the case with most emerging market companies, and the inability of these regressions to reflect the effects of major changes in the business mix and financial risk at the firm. Bottom-up betas, in our view, provide us with the best data estimates for three reasons. One, they allow us to consider changes in business and financial mix even before they occur. Two, they use average betas across large numbers of firms, which tend to be less noisy than individual firm betas. Three, they allow us to calculate betas by area of business for a firm, which is useful both in the context of investment analysis and in valuation. We turn our attention to measuring country risk exposure, that is lambda. A company's exposure to country risk is affected by almost every aspect of its operations, beginning with where its factories are located and who its customers are, and continuing with what currency its contracts are denominated in, and how well it manages its exposure to exchange rate risk. Much of this information, however, is internal information and not available to someone valuing the firm from the outside. As a practical matter, then, we can estimate lambda using one of the following approaches. One, revenue breakdown. The simplest way of estimating it is to use the proportion of a firm's revenues that are generated in a country and scale this to the proportion of the revenues generated by the average firm in that country. That is, lambda is equals to proportion of revenues in the country divided by proportion of revenues in country for the average firm. Thus, a firm that generates only 40% of its revenues in Indonesia, when the average firm in Indonesia generates 80% of its revenues domestically, will have a lambda of 0.5 for Indonesian country risk. Note, though, that if the remaining 60% of its revenues are in Thailand, you would have to estimate a lambda for Thai country risk and add that component to the cost of equity. 2. Regression versus country bond. A second approach to estimating lambdas would be to run regressions of stock returns for each firm in the emerging market against the returns on the country bond. In Brazil, for instance, this would involve regressing returns on each Brazilian stocks against returns on the Brazilian country bond, the C bond. The slope of this regression should measure how sensitive a stock is to changes in country risk, since country bond returns are direct measures of country risk, and thus yield a measure of lambda. For instance, if regressing Embraer's stock returns against returns on the C bond yields a slope of 0.3, and that the average slope across all Brazilian stocks is 0.75, the lambda would be 0.40. That is 0.30 divided by 0.75. The expected return on an equity investment in a firm, given its risk, has strong implications for both equity investors in the firm and the managers of the firm. For equity investors, it is the rate they need to earn to be compensated for the risk they have taken in investing in the equity of the firm. If, after analyzing an investment, they conclude they cannot make this return, they would not buy this investment. Alternatively, if they decide they can make a higher return, they will make the investment. For managers in the firm, the return investors need to make to break even on their equity investments becomes the return they must try to deliver to keep these investors from becoming restive and rebellious. Thus, it becomes the rate they must beat in terms of returns on their equity investments in projects. In other words, this is the cost of equity to the firm. While equity is undoubtedly an important and indispensable ingredient of the financing mix of every business, it is but one ingredient. Most businesses finance some or much of their operations using debt or some security that is a combination of equity and debt. The costs of these sources of financing are generally very different from the cost of equity, and the cost of financing for a firm should reflect their costs as well, in proportion to their use in the financing mix. Intuitively, the cost of capital, if the weighted average of the cost of the different components of financing, including debt, equity, and hybrid securities used by a firm to fund its financial requirements. I shall end here for today. Next time I shall turn to the cost of debt.